It's such a pleasure to be back with part two of the exponential exit private markets, public ambition pass. Again, we're talking about $14 trillion opportunity. That's how big it is. That's how big is this opportunity for small businesses looking to access capital markets. And as it happened with part one, I'm joined by James Hunt with part two. Now, James is a private market expert, and I just welcome you, James, to introduce yourself.
Lovely. Thank you, Matteo, for inviting me onto the exponential exit. So I'm a corporate lawyer by training, City of London. I've done public company work, private company work, and this is what's happening over the next few years. I think is going to be quite astonishing in terms of change. There's going to be great opportunities for companies to realize value and great opportunities for advisors to find new ways to get good fees. So there we are.
Okay, no, thank you so much. And as ever, let me tell you about the exponential blueprint. The exponential blueprint started in January 2025. We're now trusted by 22,000 founders, investors, and C-suite executive. Our mission is not to provide you information. Our mission is to provide you transformation. Transformation for your business through intellectual property monetization, through smart finance, and through really learning all the techniques that big businesses use to become bigger. And that's how small businesses should become big as well. Now, let's dive straight into this part two. So what we're talking today is about the future of private markets and the asset match and Pisces. That's the way it's
As
pronounced.
in the sign of the zodiac, Matteo.
Yes,
Pisces, my mother's birth sign.
no, thank you, thank you. Obviously, I'm learning this myself as well. Thanks to James, who's an expert on
Right.
this. And so basically, James is gonna talk us through this major opportunity for many businesses who have never had access to capital markets. So that brings me nicely to the first question. Now, let's talk about asset match. So, what is the founding story? And let's talk about the problem, the big problem, which really pertain to probably 95 to 98% of all businesses that exist. What problem does it solve in capital markets?
Right. So we have very dysfunctional capital markets. And I think the way to really understand this is for me to go back in time when I started my career as a lawyer in the City of London. And I joined a big law firm as it then was, Clifford Turner, and I was doing what we used to call new issue work. It now seems to be called IPO work, initial public offering work. And this was perhaps the one company in 10,000 that had been formed, had established themselves over 20 years, and the founders were realizing the value. And the role of we as lawyers was to do something called verifying the prospectus. So the prospectus is a sales document, and as the lawyer, your job is to make sure that it's as truthful as possible, which is easier said than done. And you have a 5-year financial report in that document. So you have the prospectus, which is the selling document, and you then have your shares admitted to trading on a market. And unlike private company share sales, where it's very much caveat emptor, and you have the criminal law in the background if something very egregiously wrong is said, with public markets, it's supposed to be about transparency and avoiding a market of abuse. So the operators of the market, the London Stock Exchange, and they have a market called AIM, the Alternative Investment Market. They set the framework. So they tell the companies and the advisors what they have to do. So you have to publish yearly, half-yearly report and accounts. You have to disclose share trading by the directors. You have to disclose if you're going to make a significant acquisition, and sometimes you have to get permission for that acquisition. So this is all designed to ensure the integrity of the market and to avoid market abuse. And it's very different to the private company market. Now, we discussed in part one of this podcast the problems that have happened with those stock markets for public companies. And the problem is essentially this: the fund managers have become predominant. So companies like BlackRock and Vanguard, they invest trillions of dollars of funds, and they are investing through what's called passive investing. So in the old days, when I was a young lawyer starting out in the 1980s, it was active investing. You'd have a stockbroker whose job was to understand your finances, to see the trends in markets, and to guide you on what you would buy by way of shares. Now, what has happened is that you now have this passive share trading, index tracking. So it then becomes that the bigger you are, the easier it is to have a rising share price. If you're small, how do you get visibility, and how do you have share trading that is beneficial to your company? How do you get the message out there to the investing community? Because if all they're doing is investing on size and an index, how on earth, and do you get into that index? So very difficult. Um, so over the last 5 years, particularly, the alternative investment market of the London Stock Exchange, which at its peak was up to about 1,700 companies, has dropped to 700. And this is because companies are finding they're spending a lot of money on advisors, typically £250,000 a year, to maintain their AIM listing. And they're thinking, well, what do we get out of this? Because we're a small company without a voice and this passive investing is driving the market, we've got shares that aren't actively traded. And when people do trade, they might be selling them. And because there aren't buyers, the share price drops. You have a big fluctuation in the share price. So companies are just deserting the alternative investment market. What has then happened over the 15, 20 years previous to that is that what's called the private equity market has become predominant. So private equity is in a sense the opposite to the public markets. It's where skilled financial individuals will raise money privately from pension funds and wealthy individuals, and they then invest that money. And they invest it for high returns. Might be 25, 30% internal rate of return is what you're being promised. And those professional managers will have what's called a carried interest. So this is the guys running this fund will be on a personal take of the upside. Once they've returned the money to the investors, the managers of those funds then get their own personal investment, own personal return. And the way this private equity market works is by gearing up companies with debt from clearing banks.
So effectively,
Now, we
you
all remember what
discuss.
happened in 2000.
No, no, sorry. What I was going to say. So effectively, what you said before, there's a high barrier to entry to the stock market, and private equity effectively is taking over. Yes, so that's the kind of summary. But go ahead.
Yeah.
Tell us more about
Yeah, so
this kind of that. Yeah.
private equity has taken over, and then the problem with private equity is this: if you went back to the 1950s, there was an organization called Investors in Industry, 3i, and that
Hmm.
was created because of what was called the Macmillan Gap, the difficulty for small private companies to access risk capital. So 3i was set up to fulfill that purpose, and it was very successful, and others started to copy it. So I remember when I was practicing in Birmingham in the late 1980s, Lloyd's Development Capital came to town. Now, the guy who ran it was Michael Joseph. He was ex-3i. He went on to run the whole of what became LDC. So they dropped the Lloyd's Development Capital because they're now LDC. And what they do is these leveraged buyouts. So it's a completely so they're interested in big transactions where they will load the company up with debt. And that means if the company does well, there can be a very significant return, not just for the fund investors, but for the individuals who have the carried interest in that fund. So what we've got is a culture of professional investors who are incentivized really to take significant risk. And this is the problem we saw in 2008 when the financial markets crashed. People were doing extraordinary deals. I remember the eminence grise of private equity is a guy called John Moulton. When I was at Clifford Turner, he was with Citicorp, then he was with Schroders, then he set up Alchemy Partners. And I remember going to a conference in mid 2008, and it was just after the crash. And John Moulton put up on a big screen the faces of the CEOs of all the big clearing banks. And he looked at them, and I'm going to be slightly crude here, and he said, "These are the bastards who destroyed the market." And he told this story. He was trying to buy Boots, and it was obviously competitive. And he said the people who eventually bought it, I forget which private equity house it was, bought it on a multiple of 10 times EBITDA. And they knew they could not pay the first year's interest on the debt. So they knew when they raised the money, they were going to have to refinance within 12 months.
As EBITDA, people think, EBITDA is everything, but then if you got interest and tax underneath EBITDA, will
Yeah,
kill will
just
kill the
just
cash flow,
madness,
effectively. Yeah.
just madness. And then what we discovered in 2008, of course, is that when the music stops, it's the taxpayers that pick up the bill. So
Hmm.
we're all told, "Oh, look, that we can't let the big commercial banks collapse. We've got to bail them out." And I'm afraid one can see that we're getting to this stage. Anyway, so so I was talking to the founder of Asset Match, Ian Bailey, recently, and he was saying, of course, for the last 15 years, private equity has effectively had free money. Now, it's not free to we, the taxpayers, because if there's a collapse, we're going to have to bail out the banks again. But, but it's free for those taking the risk. So this is the dysfunctional markets as I see them. Now, the real generators of wealth in this country are small, medium-sized enterprises. They employ about 60% of the population. It's where the wealth is generated. We have the City of London, which is financial markets, casinos, people betting. Heads they win, tails we lose. So dysfunctional. So now, so to understand the background, let me mention this, and I hope I'm not being too long-winded, but I moved from the City of London and I went back home to Birmingham, as we call it, Birmingham. And I formed a friendship with a stockbroker in Birmingham who was partner in a firm called Griffiths and Lamb. And a market called OFX was just coming to life. And John said to me, well, this is going to be good business for us, James. So we worked on a number of OFX floats. It was great fun. So the OFX story was this. There was a very nice jobber. So this was someone who traded shares. So in the stock market before Big Bang, you had people who were jobbers and people who were brokers. Jobbers trade as principals, brokers trade as agents. So John Jenkins was a jobber. So he made his money from trading shares. So he thought, right, there's a big opportunity here. It proved not to be such a big opportunity because I think he didn't really understand the mindset of the entrepreneur. So he thought he was going to make a lot of money trading shares. But if you've got a company capitalized, I don't know, 2, 3, 4, 5, 10 million, you're not going to make much money trading their shares because the floats, the shares the investors are going to buy are going to be relatively small. It's only when the founder realizes they're 80, 90, 95% that there's value to be made. And it then tends to be the merger broker, the lawyer, the accountants who make the money, not the guy doing the the share trading platform. Anyway, OFX had an interesting rise and then sad fall. So back to my comment earlier about integrity in the markets. I remember they had a company that was the darling of OFX, and it was called Display IT Holdings. And it went up to 150 million market cap. And then someone discovered that it wasn't all it was made out to be. There was a bit of dodgy accounting going on. So it collapsed. And of course, in that situation, the regulator, in those days, it was the Securities and Futures Authority. This was before the FCA, were concerned because they were saying, right, well, have investors lost money because this market didn't have integrity? And for several years, the SFA were putting pressure on JP Jenkins to become what's called a recognized investment exchange, which is what the London stock market is and what AIM is. So what they wanted was more regulation, so there would be more transparency, and so investors would not lose out. And eventually, JP Jenkins succumbed to that pressure, became a recognised investment exchange. And I remember John Jenkins saying to me it cost them £500,000 a year in costs. And then because they weren't making enough money from the trading of the shares, um, they um, they ended up in financial difficulty. They had to be sold out to a new company called Plus Markets, who, if memory serves me correctly, took the guy who was running AIM, a guy called Simon Brickles. He became the CEO. And then 3 or 4 years later, Plus Markets got into financial difficulty. So it's actually, I would say, very difficult to make money running a market. So, to my mind, it's more normally suited to what I'd call a mutual society. So, this is what the London Stock Exchange was. It was a club. So that the people who were the jobbers and the stockbrokers became members of the club, and it was their club. And you don't want your club to make money. Your club is there for you to make money. I'm a member of a club called the Law Society, and that's how the world works. Anyway,
Oh,
so
no, that's
so
great. Thank you for this. And I mean, I think what James has actually brought exceptionally well here is really the issue about democratization, really. Because what we see in our world, we see so many our situation, we got really the 95 to 99% of the economy effectively is made by small business, small
yeah,
organization. And generally speaking, not too many people, not too many people talk about these businesses at all because the press is really busy talking about the big businesses, shall we say. And
yeah,
what you have described is a situation in which it is so difficult, so uneconomical, shall we say, to compete with, in capital markets with the big businesses. And that's the solution. That's the problem we're trying to solve. Yeah. So
it is exactly the
that's the
problem.
problem we're trying
So
to
let me
solve.
pick up on that lovely word democratization, because that brings me on to the next bit of the story I'd like to tell. So we told the story of Ofex, which was a jobber who sadly wasn't able to succeed with Ofex. I'm now going to tell the story of a gentleman called Gavin Oldham, who was a stockbroker. Now, he created the country's largest execution-only stockbroking business called the Share Centre up
Hmm.
in Aylesbury. And Gavin was absolutely passionate about democratization and everyone should own shares, personally. So when his company became successful, he decided he was going to give 15% of his company to his customers. So, and then he thought, hang on a minute, if I give 15% of my company, that'll mean I've got 10,000 shareholders and they've got, I don't know, three, four, £500,000 worth of shares. How do I ensure that they can cost effectively trade those shares? And he thought, well, the current market is dysfunctional because you have jobbers who are making a market. They have to make a margin on the shares. And then you've got the stockbroker who has to charge his commission on the purchase or sale. So this isn't going to work. So he came up with a wonderful idea. He created a platform called ShareMark. And instead of this operating through stock brokers and jobbers, it operated through an algorithm that would match buyers and sellers at the optimal price. And I remember a partner of mine at the time, Paddy. He had a client. Dairy Farmers of Great Britain, and they had a lot of loan stock and 6,000 farmers wanting to trade their loan stock. It was the way they financed the business. Paddy went to Aylesbury and met the Sharemark people, and he came back very excited. He said, James, you'll love this. You must come and meet the Sharemark people." So I went, and I was, yeah, because I've always been an evangelist for democratization and the small guy and how they unlock value. So I went along. I thought, this is wonderful. And I kept evangelizing about it to my clients. And it was a complex subject. We'll come on to that. So eventually I thought, when I started my business, Everyman Legal, right, I'm going to take Everyman Legal onto Sharemark, and I'm going to become my own case study and show everyone else how to do it. And I got it all worked out. The only problem was I couldn't scale my business. As I said in part one of this podcast, that was a great disappointment for me.
The Pisces vision, though, the Pisces vision, that this is the question that we were talking about before. How did Asset Match become involved in the Pisces vision under the London Stock Exchange?
Right,
And
right. So,
for the
right,
listeners, tell us about
right.
what Pisces is.
Right. So what happened was Gavin eventually decided Sharemark couldn't work, and he sold it. Or my guess is he gave it away
Yeah.
to two gentlemen, Ian Bailey and Stuart Lucas, who had the idea to set up Asset Match, and this was about 12, 13 years ago. So Sharemark became Asset Match. And Stuart and Ian were share traders, city traders of gilt-edged securities and shares. So they understood trading. And I would think they cast a rule book over Sharemark and OFX and thought, right, this can't work the way it's being organized. So they came up with what I would call the Sotheby's solution. So Sotheby's very cleverly charged both a seller's commission and a buyer's commission. And that is what Asset Match does. They charge a seller's commission and a buyer's commission. So that was the variation to the model of Sharemark. So it's exactly the same as Sharemark. You're matching shares and you're doing it on a periodic auction basis. So the difference between a traditional stock market and these markets is this. Traditional stock market, you've got the stockbroker making a market in the shares. You had to have two for the USM. I think you still have to have two for AIM. Then you have the stockbrokers buying and selling the shares, and it's a continual market. And that means you can have fluctuations on the buying and the selling price. What Asset Match does is you choose, as the owners of the company, how frequently the shares are going to be traded. So you could say it's daily or weekly, but you more likely you'll say it's monthly or quarterly or half yearly or yearly. And what you are then doing is matching buyers and sellers on a periodic auction basis. So it's a very clever way of bringing buyers and sellers together.
And the Pisces, what does it mean exactly, each word? Explain it for the audience, yeah.
What was the word?
Pisces, P for,
Pisces, right.
yeah.
So Pisces, I keep forgetting the acronym. The world's full of acronyms, isn't it?
So private intermittent,
Private intermittent securities, a capital exchange system. So someone must have taken hours to work out how to create this
So
acronym.
this is
So
very important
effectively,
for the listener,
and
So
very important.
remember this
Yeah. So,
Pisces is it means something.
but what it means is you're not having continuous trading. So that's the difference. The intermittent is the key word
So you don't
to
have to
focus
have
on. And
the
private,
trading.
private and intermittent.
So the
Public
market
market,
opens and closes, but it doesn't open and close like it does on a public stock market. It doesn't stay open all the time. Yeah, just if you can
correct.
tell this to our listeners, so they
Yeah.
will get it clear.
So you
Yeah.
don't have continuous trading, which is what you would have on a
Okay.
public stock market. Um, and a great thing with public markets is whether you have to suspend your shares, because this is a big sin and a big worry. So, the shares are suspended. That might mean you're about to go bust or you've had a takeover approach. Often it's not good news. And then, hang on, I've got shares. I want to sell them. How do I sell them? And you can't. The shares are suspended.
So what's the great really take away from many people here is that uh, while in capital markets, the public markets they stay open like, from let's say 8 o'clock in the morning
Yeah,
until I think in the UK it's 4:30 in the afternoon, and in Europe
yeah,
it's from 9 a.m. to 5:30
yeah,
p.m. With Pisces instead, what you have is you have access to capital markets, but without the necessity to have the shares traded continuously. Uh, so basically, you can actually open, it's like, when you open and close a shop, you don't have to keep it
yeah,
open all day. You open it, let's say, once a week or once a day or one
yeah.
hour a day, 1 hour a week, 1 hour a month. Yeah. So that's the
So
really
so
big
it's
breakout.
much less pressure for the directors running the company.
So that's a fantastic
Oh, it is.
news, because let's face it, out of let's say millions of companies, let's say in a particular country like in the UK, so it's probably a million businesses there. Right now, probably 99% of those, let's say if it was a million, it would be 950,000 or more. They don't have access to any sort of capital markets. Instead, with this particular vision, there is a potential to give access. I mean, and we're talking about really helping a free in the UK. We're talking about $3 trillion economy. If you're talking about the USA, we're talking about $30 trillion economy,
Yeah,
10 times bigger. So just imagine, this is for the listener, just imagine what such a big opportunity this is. That's why when we started this conversation, we mentioned about the $14 trillion opportunity. Okay.
yes. Yeah, so there's a great George Carlin comedy sketch. It's a big club and you're not in it. So we've got to be very careful that this isn't a slightly smaller club and you're not in it. So my guess is this: the it's the Treasury and the Financial Conduct Authority that have been
Mhm.
really pressing for Pisces. And I understand that moves to create it go back 5 years. The London Stock Exchange, which is now a big data and technology company, and the London Stock Exchange itself only accounts for 2% of revenues. I think not particularly interested in it. They're making their money elsewhere. Um,
So I
so
guess
the
we answered
danger,
the question, why is it a game changer? We answered that
right?
question.
So it
However, if
should
you want
be.
to add any more,
It
yeah.
should be a game changer. It
Mhm.
is, but it's been a brilliant tool for 12 years. So we didn't actually need the Treasury, the Financial Conduct Authority to say, right, we're going to create this thing called Pisces. Because Asset Match have been doing this for 12 years.
We should be talking more about this, James. Why are we not talking more about this? What's your
Why are we not talking about Asset Match?
no, why are we
It's
not talking about such an opportunity for private companies more? What do you think, that there's
right.
been
Very
not sufficient?
simple, Matty. I'm afraid there's not enough money in it for the professional advisors. So I've been going on for years saying this is the City of London's best kept secret. And it's the best kept secret because the advisors make money taking companies on to AIM, or they make money selling to private equity. They're not going to make lots of money putting companies on to Asset Match or Pisces.
So
But
this is where
I would say, who cares?
this is
In
where
the
the
sense,
democratization comes in. We are
yeah, well,
coming to you, small businesses. You've been left behind. Now
yeah.
there's an opportunity, yeah?
And what we want is to generate wealth in the UK economy, don't we? So this should be wonderful for wealth creation. And in fact, then it will generate lots of business for professionals, but just different business, a broader club for people
So,
who want to help businesses grow. So it is a wonderful opportunity. And I've been banging this drum for over 12 years. And finally, because there's going to be a lot of publicity around Pisces, and Asset Match is applying to be a Pisces operator, there will probably be three or four others. Suddenly there's going to be publicity. And when there's publicity, you have the opportunity to say, oh, look what you could actually do.
I mean, let's suppose I'm a founder, okay? I have a business, small business, of course. I just can't go into an IPO. I don't have any intention, and that would be 99+% of the businesses, yeah. and
Yeah,
I'm interested in intermittent share trading. Now, would
yeah,
you explain to me what I need to do? How does intermittent share trading work? And what are the benefits over a traditional IPO? I mean, again, I'm pretending I'm a founder. So tell
right.
me.
Okay, so the words of wisdom were always this. When someone comes to see you and says, I want to list my shares on a public market, you should spend at least 7 or 8 hours explaining to them why they shouldn't.
It's a
Because
good start.
it's a good start. Because often it requires a significant change in behavior. Perhaps you've been running your company without a rigorous eye to expenditure. You might have your wife as a director and your son as a paid employee, and some of this personal expenditure might need to be eliminated because an investor will say, well, whilst you love your wife dearly, we don't think she's contributing enough to be paid this salary. So you've got to clean up your act. Then you have to be able to tell a compelling growth story. And this is true whether you're going onto a public market or you're going onto Asset Match or Pisces, because investors want to see a return. Now, you could give them a good return, which is dividend income rather than capital growth. But at the end of the day, you've got to tell a compelling story to investors. So if you are a very small company, clearly this is not going to be appropriate for you. But if you are an ambitious company looking to grow, perhaps indeed you're looking to grow through using your share capital to make acquisitions, and you can then point to your share trading on Asset Match or Pisces and say, look, this is what the price has done over the last 2 years. You should have confidence in our company because you can see other people have confidence in it. And then you will up your game, you will produce um, fuller report and accounts with a strategic report, and you will have to tell your story. Now, the challenge in life is telling a compelling story. It's got to motivate you first, then other people. And you have to say where it is you're going, because otherwise people will go, "Oh, I'm not sure I want to be on this ship. Doesn't seem to be going anywhere."
So basically, what you're saying is that so obviously, this is such a game changer because it will open up what is going to close. What you mentioned before about the barriers of entry to capital markets
Yeah,
is a major consideration because
yeah,
let's just imagine how many businesses right now are potentially stagnating because of lack of capital, because
yeah.
they would like to do more with the business, and they are constrained by the lack of capital. So yeah, so we're reaching out really to the majority
Yeah,
of all the
but one
businesses.
one caveat though, Matteo,
Yeah.
Pisces is not going to allow new money to be raised. So it's a market for second-hand shares.
But again, this is where founders
But
would have
yeah,
a partial
yeah,
exit, yeah?
yeah. So but the point is this: no no wise investor wants to invest without asking, how am I going to exit? So you could put money into a company even if it's not on Asset Match or Pisces. And if then the company tells you its ambition within a year or two is to have its shares traded on Asset Match or Pisces, you then know you're more likely to be able to exit. So quite frequently in the old days when people were putting in money, you'd say, right, our ambition is to go on to AIM. Now that's very difficult ambition and everyone's coming off it. So yes, being able to sell your shares relatively easily is often a precondition to people being prepared to put new money into a company. But Pisces, as currently conceived, will not allow prospectuses to be issued to raise new money. It's for dealing in second-hand shares. And my guess is it's been driven by lobbying by private equity who are now locked into companies. They can't exit onto stock markets. They have been playing pass the parcel one private equity house to another private equity house, but now they're thinking, right, this will be a way to unlock capital. And what I think we have to do, my mission, Matteo, with you is to help business owners on the growth path, the exponential growth, which then means that they will be suitable for a market like asset match or Pisces. And they will then be, this is a really a sophisticated communication tool, is what asset match and Pisces can be. And the communication starts with the founder of a company and his advisors. Where is it I want to go? And then you will start to tell that story through your report and accounts to potential investors. People will gain confidence, and critically to your employees, because asset match and Pisces can be a great way to give really rewarding share incentives. So not just a piece of paper that's an option certificate or is a share certificate and what money do I get from it because you're not paying much in the way of dividends. This could be right. We're encouraging employees to exercise their options and then to trade them periodically on asset match or Pisces. It's a
I can
wonderful
see
opportunity for companies.
I I can see a world of benefits from this.
Yeah,
I mean, I could give a big list here, but one, let's just go through a couple of really big benefits here. First of all, the valuation of the business will be supported by share trading,
yeah,
even if there is not potentially even new fundraising. So what does that mean is that if you approach an investor, you're able to prove to the investor that the valuation of the business is supported by an actual transaction in shares. So that's a very important thing, you know. Now,
yeah,
what that will allow you as a founder is to be able to approach investor externally and prove what your business is worth. Now, obviously, that will make it even easier to approach banks when you're looking for funding because you are able to show to a bank effectively what your business is worth according to the share trading, of course, you know. Now, last but not least, for those who are super ambitious, you could actually eventually decide to make a big leap into public capital
yeah,
markets.
yeah. You can
So
indeed.
you can actually upgrade. Say you've been on Pisces for 1 to 5 years.
Yeah,
Finally, you want to behave like Jeff Bezos or
yeah,
or Elon Musk, or I mean, let's say, obviously, having that kind of ambition, you will start from a position that you will not have had if you just have to go straight in. You'll be able to really give the track record to investor about the valuation of the shares. Now, obviously, you were mentioning, James, about the employee as well,
yeah,
because employee share scheme, they are fundamental to so many businesses' success. You know,
yeah,
recently we've seen an example, a glamorous example like Nvidia, where with just 30,000 employee, they have they've broken through a $4 trillion valuation.
yeah.
Now, usually these are the businesses that they just do so much better than anyone else when we go employee participation. So yeah, the benefits are quite varied. I don't know if I missed any of those. Feel free to add any, James.
No, I think that sums it up very nicely. It is a wonderful opportunity. And the thing is, we as advisors have to educate ourselves on how it can be used. And we have to then form a very big club, which is the idea of Sophie in 1845, where we inspire ourselves and support one another to get as many companies as possible using this sort of platform. And it can be a stepping stone, as you rightly say, to a public market or a trade sale or a sale to private equity. And I saw that happen a number of times with clients of mine with OFFEX. They would use OFFEX as a stepping stone. I had one use it as a stepping stone to being acquired by a listed company on a reverse takeover. I saw another company use OFFEX as a stepping stone to an AIM listing, and this company grew and was sold eventually for £450 million. Sportingbet.com.
Well, that's where the big benefit is about
Yeah.
visibility. I always say this is from invisible to investable. Okay, that's
Yes.
what we're doing, you know. Just talking
Yeah.
about regulation, you know, why do you think the FCA uh, choose right now to launch this framework, and what market gaps they are addressing in their own mind? What do you think is the thinking?
Right. So if you're going to have a growth economy, you need to find ways and means to support ambitious companies to grow and exit. And that's it at its fundamental level. My guess is they are being lobbied by private equity who want a way to unlock value. Um, and rightly, as regulators, they want to ensure that there's a balance between the risks to consumers and the opportunity for companies to raise money. So they're creating a structure which is designed to be a hybrid between the public and private markets to give some protection. And now this is a regime that's being introduced for 5 years, and they call it an FCA sandbox. I can't ever resist a smile at a sandbox. I would have just called it a 5 year trial, but sandbox makes it sound, I don't know, at one level quite juvenile, at another level, oh, quite sophisticated. Anyway, it's a 5 year trial. The Pisces operators and asset matchers applying to be a Pisces operators will choose their own rule book within the overarching framework that the FCA has created, and a statutory instrument came in May, which is part of the enabling process. So there'll probably be three, four, five Pisces operators, of which Asset Match will be one, and they will each have their own rule book. Somewhat might be more restrictive, requiring more disclosure. Some might be less restrictive. But what I would say, as a plug for Asset Match, they've been doing it for 12 years. They understand the craft because it is a craft. Everything won't be straightforward because you can have your own rules on who's allowed to buy the shares, and the minimum and the maximum prices, and you can have family shareholders that could trade different classes of shares. So there's all sorts of things they've learned over 12 years that they can teach all of us who are evangelists and are enthusiastic about this private market to operate it in the most flexible and beneficial way. So I'm very excited about the opportunity.
Oh, thank you so much, James. This has been such an exciting part because we really discovered so much. We discovered really about this democratization
Yeah,
of the capital markets. And I think from today onwards, anyone who uses the word Pisces, it will become so memorable. Obviously, the difficult part is to remember all the various parts of the acronym,
yeah. I'd say don't
which is,
bother.
let's just repeat, private intermittent security
And exchange capital system.
capital exchange system.
The only word to really remember, two words: private and intermittent.
Private and intermittent, yeah. So it
Private
really,
and intermittent.
private and intermittent. So it's a game changer. It's a game changer, founders, yeah.
It should
Uh,
be, should be.
So that's yeah, it's been great. And this was part two. In part three, we're gonna talk about how do we empower private companies. And you'll be able to access this video by clicking to the left, effectively, of the screen at the end of this video. While let me remind you to subscribe to our YouTube channel, which is can click to the right at the end of this video. It's been a pleasure concluding this part, and we'll see you on the next one. And thank you so much, James.
Lovely. Thank you, Matteo, for
Thanks.
having me on the exponential exit. Bye
Thank
for now.
you. Thank you. Okay, so I paused it. How did you feel?
It's good. Yeah, no, I liked it. I enjoyed it.
When do we want to do
Thought they
the
had a good
next
rhythm.
one? When you want to do the next? Yeah, I mean, it requires a bit of adjustment, but I think, what we're going to do is I want this to become this Pisces is such a game changer that it deserves really yeah, it deserves a lot of
Yeah,
yeah, a lot of a lot of
yeah,
time, a lot of time, yeah.
yeah. When would you like to do the next one, Matthew?
As soon as possible. I just wonder, so tomorrow I'm traveling. Do you want to do a Q session on the weekend?
Yeah, happy to do Saturday morning.
Okay, Saturday morning. Do you want to do 11 o'clock? Is that okay with you?
Yeah, I can do 11.
And then another one at